Right now, the average American over 65 is writing checks they are legally not required to write. Not one check, not two, 5 separate bills, every single year, that the law already says they don't owe. And the reason they keep paying isn't negligence. It isn't ignorance. It's something more specific than that. Every single entity collecting those bills has a direct financial incentive to stay quiet. Your county doesn't call you when you qualify to freeze your property taxes. Social Security doesn't remind you that you can adjust the withholding coming out of your monthly check. And the tax office charging you $350 doesn't open the conversation by telling you that you may legally qualify for the same return done at no cost. Before I go any further, I need to address the assumption that kills most people's attention in the first 30 seconds of a video like this. Half of you are thinking, this is for low-income seniors. I'm comfortable. This doesn't apply to me. The other half are thinking, this is some advanced wealth strategy. I'm living on Social Security. This isn't for me either. Both of those assumptions are wrong, and I'll tell you exactly which group benefits from each item, every single time, so nobody watching can say this list isn't theirs. I'm Ellis Rowe, an enrolled agent licensed by the federal government to represent taxpayers directly before the IRS. The most expensive pattern I see in my practice isn't fraud. It isn't carelessness. It's honest, careful people in their 60s and 70s at every income level, silently overpaying bills they never owed, year after year, because no one told them they could stop. 5 bills. 3 bonus moves at the end for retirees who've built up real assets. Stay through all of it. The last item is the one that quietly drains the most money and takes the least effort to stop. This video is for educational purposes only and does not constitute tax or financial advice. Consult a qualified professional for guidance on your specific situation. Bill 1. Federal Income Tax. For millions of seniors, the correct amount of federal income tax going forward is dramatically lower than what they're currently paying. For a significant portion of you, that number is 0. And many of you are still paying, or still having it withheld, out of nothing more than habit and fear. Here's what changed. Buried inside the legislation you've heard referred to as the One Big Beautiful Bill is a provision called the Senior Bonus Deduction. Starting with the 2025 tax year, the return you file in early 2026, every person aged 65 or older receives an additional deduction of up to $6,000. If you're married and both spouses are 65 or older, that figure doubles to $12,000. Here's what makes this genuinely powerful. It stacks. It sits on top of your regular standard deduction. It sits on top of the existing additional deduction seniors have always received for being over 65. You don't have to itemize. You don't surrender anything to claim it. It simply gets added. Now, who does this help? Both groups, and here's how. If you're a lower-income senior living primarily on Social Security, stacking these deductions very likely brings your federal income tax liability to 0. It may even eliminate your filing requirement entirely. If you're a comfortable middle-class retiree, you're not excluded. The deduction is available in full to single filers with income up to $75,000 and married couples up to $150,000. It begins phasing out above those thresholds and doesn't disappear entirely until $175,000 single or $250,000 married. The only retirees this genuinely bypasses are the wealthy. Everyone else, from a modest fixed income to a couple bringing in $110,000 a year, gets real, tangible money here. One critical detail: this is temporary. As the law currently stands, the senior bonus deduction applies to tax years 2025 through 2028 only, 4 years unless Congress acts to extend it. That makes this a claim it every year while it exists situation. If you use tax software, it applies automatically. If someone prepares your return, confirm they applied it. Don't leave it to assumption. That's Bill 1, and it's the highest value point in this entire video. Bill 2. Tax on Social Security benefits. This is the other half of the same conversation, and there are 2 firmly held beliefs about it, both incorrect. The first belief: Social Security is always taxable. The second: Social Security is never taxable. Neither is true. Here's the actual rule. Whether your benefits are taxed depends on something called your provisional income, your other income plus half of your Social Security total. If that number comes in below $25,000 for a single filer, or below $32,000 for a married couple, 0% of your Social Security is taxable. Nothing. As that number climbs up to 85% of your benefit can become subject to tax. But even at the very top of the income scale, 15% of your Social Security remains permanently tax-free. Here's the win for each group. Lower income seniors. There's a real chance your correct Social Security tax is already zero, and the new senior bonus deduction pushes even more people past that threshold. Comfortable retirees. The new deduction can still reduce the taxable portion to a lower tier, even if it doesn't eliminate it entirely. Here's the mistake that hits both groups equally. When people claim Social Security, many check a box or submit a form called the W-4V, instructing the government to withhold federal tax from every monthly payment just to be safe. Then they wait for a refund the following spring. What that actually means is you're giving the government an interest-free loan all year long on tax you may not owe at all. The correction is straightforward. Review your actual numbers, or have someone review them with you, and file a new W-4V to calibrate or eliminate that withholding so it reflects what you'll genuinely owe. Pay exactly what you owe on time, and not 1 cent before. Bill 3. Property taxes. This is the one that generates the most frustration, because it's also the one where seniors at both ends of the income spectrum are most often told they don't qualify when they very frequently do. There are 3 distinct categories of senior property tax relief, and together they cover nearly everyone. Category 1 is income-based relief, often called a circuit breaker. This is designed for lower and fixed-income homeowners. Depending on your state, it can dramatically reduce your assessed value, defer your tax entirely, or eliminate a large portion of the bill. Category 2 is a flat senior exemption, a fixed reduction off your home's taxable value, regardless of income. Category 3 is the one comfortable retirees consistently assume they're ineligible for, an age-based freeze with no income requirement whatsoever. Texas is the clearest example. The moment you turn 65, your school district property taxes are frozen at the level you paid the year you qualified. Your home's value can increase substantially. Your frozen tax doesn't move. There is no income test. You qualify solely because of your age. Texas is not an outlier. Multiple states operate similar programs. So here's how the coverage breaks down. Lower income seniors access income-based relief that can eliminate most or all of the bill. Comfortable seniors who are shut out of income-based programs still qualify for age-based freezes and exemptions they've been assuming weren't for them. The universal catch: not one of these programs is automatic. Your county doesn't check your birthday and apply a discount. You have to file an application. And virtually every program has a hard deadline, often early in the calendar year. Miss it and you pay the full amount for that year and start over in January. Make one call. Contact your county assessor's office and ask 2 specific questions. What property tax relief programs are available to homeowners over 65? And which of those programs are age-based with no income limit? That call has been worth hundreds, often thousands, of dollars annually to people I've worked with at every income level. Bill 4. Medicare premiums. 2 separate overpayments are hiding inside your Medicare bill. One affects everyone, one targets higher earners specifically. Overpayment 1. For everyone. Medicare Part A, which covers hospital stays, carries 0 premium if you or your spouse worked and paid into the system for at least 10 years, 40 quarters. The overwhelming majority of Americans meet that threshold without question. Yet some retirees pay a Part A premium they never owed, due to confusion about their work record or their spouse's. That's worth a direct verification regardless of your income level. Overpayment 2. For comfortable retirees, it has a name that sounds like a person. IRMAA. The income-related monthly adjustment amount. Once your income crosses certain thresholds, Medicare layers a surcharge on top of your Part B and Part D premiums. By definition, this only affects people with meaningful income. Here's the trap within the trap. The income Medicare uses isn't this year's. It's your tax return from 2 years prior. So, if you were 64, still working, earning a solid salary, then retired and watched your income drop significantly, Medicare will still assess your premium based on that old, higher income figure. It shows up as a quiet deduction from your Social Security payment. Most people assume it's correct and pay it without question. It may not be correct. And there's a form designed exactly for this situation. It's called the SSA 44. When you've experienced what the government defines as a life-changing event, and retirement is specifically listed, alongside death of a spouse, divorce, and a significant income reduction, you file that form, demonstrate your income has changed, and Medicare recalculates your premium based on your actual current situation. I've watched that single form return thousands of dollars a year to retirees who assumed they simply had to pay the surcharge. Almost no one files it because almost no one knows it exists. Bill 5. Tax preparation fees. Every year, millions of seniors walk into a chain tax office and pay $200 to $500 for a straightforward retirement return, two Social Security statements, a pension, maybe a few investment accounts, when they legally qualify to have the exact same return prepared for free by IRS-certified professionals. The program is called TCE, Tax Counseling for the Elderly. It's an IRS program designed specifically for people 60 and older, built around the exact questions retirees face: pensions, Social Security taxation, retirement account withdrawals. The largest national provider is AARP TaxAid, which operates thousands of locations across the country. You do not need to be an AARP member to use it, and modest to moderate means covers far more income levels than most people assume. It reaches well into the comfortable middle. I'll be honest with you. As an enrolled agent, I'm partly talking myself out of revenue by telling you this. But a straightforward retirement return doesn't require a $350 chain storefront appointment. The law already built you a qualified free alternative, and your age makes you eligible regardless of where your income falls. Here's the honest line, though, and I'll say it plainly. If your situation is genuinely complex, a business sale, rental income, a complicated estate, pay a qualified professional. It's worth every dollar, and I'd tell you to do exactly that. But if your return is routine, stop paying for something the government already funded for you. Bonus. Move 1. Home sale tax. This fear lives quietly in more retirees' heads than almost anything else. You bought your home decades ago for $65,000. It's now worth $420,000. You've been afraid to downsize, afraid to sell, convinced the government will take a chunk of that gain. So you stay in a house that's too large, too expensive to maintain, and no longer fits your life, because of a tax bill that in most cases doesn't exist. Here's the actual rule: the home sale exclusion. If you've lived in your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of capital gain from tax if you're single, and up to $500,000 if you're married filing jointly. That's gain, not sale price. Gain is what you sold it for, minus what you paid, minus qualifying improvements. A married couple who bought for $65,000 and sold for $420,000 has a gain of roughly $355,000. Their exclusion is $500,000. Their federal tax on that transaction? 0. They were sitting in the wrong house, paralyzed by a tax that was never going to touch them. Bonus move 2. 0% capital gains bracket. If you hold appreciated stocks or funds in a regular investment account, not an IRA, a taxable brokerage account, this may be the most underutilized provision in the entire tax code for retirees. When your taxable income falls below a certain threshold, the federal tax rate on long-term capital gains isn't 15%. It isn't 20%, it's 0. For 2025, a married couple can have taxable income up to roughly $96,700 and pay 0% on long-term gains. For a single filer, that threshold is approximately $48,000, and that's taxable income, meaning after your deductions come out. A couple with over $100,000 in gross income can still land inside the 0% zone after the standard deduction and the senior bonus deduction and sell appreciated investments without paying $1 in federal tax on the gain. Retirees are uniquely positioned to use this. In the years after you stop working and before required minimum distributions begin forcing large withdrawals, your income is often at its lowest point in decades. That is the window. Strategic retirees harvest gains deliberately during those years, completely tax-free, rather than letting them accumulate and face higher rates later. Bonus move 3. Qualified charitable distributions. If you're 70 or older, give anything to charity, and have money in a traditional IRA, this is one of the most powerful tools available to you and one of the least discussed. It's called a Qualified Charitable Distribution, or QCD. Once you reach 70 years, you can direct money straight from your IRA to a qualifying charity, up to $108,000 per year. That money is completely excluded from your taxable income. You might say, I already deduct my charitable donations. Here's the problem with that. Most retirees today take the standard deduction, which means their charitable giving produces 0 additional tax benefit. They're not itemizing, so the donation deduction doesn't help them at all. The QCD bypasses that entirely. The money never registers as income in the first place, which is more powerful than a deduction because it reduces the baseline income figure that everything else is calculated against. Your Social Security taxability, your Medicare surcharge, all of it shifts downward. And once you reach the age where required minimum distributions kick in, a QCD counts towards satisfying that requirement. Instead of being forced to withdraw funds, pay tax on them, and donate what remains, you send the money directly to the charity, satisfy your withdrawal requirement, and owe nothing. If you give to a church, a cause, a community organization, and you have an IRA, this isn't just a tax strategy. It's the most efficient way to give that exists. Here's the single idea that ties every one of these together. In every case I've described, the law already says you qualify. The senior bonus deduction is written into the tax code. The property tax relief is on the books in your own county. The Medicare appeal form is on the government's own website. The free tax preparation program is funded and operating. The home sale exclusion, the 0% capital gains bracket, the charitable distribution, every one of them is real. But not one of them is automatic. The government does not send you a refund for a rule you never claimed. Nobody mails you a check for the deduction you forgot to take. The entire system is structured so that money stays exactly where it is unless you stand up and claim it. Subscribe to this channel if you want this kind of information delivered consistently. No products, no pitches, just the specific rules and strategies that protect what you've already built. And do one more thing. Send this video to someone in your life who is over 65 or getting close. A parent, a neighbor, a friend. It doesn't matter if they're on a fixed income or sitting on a paid-off home with a full investment account. The odds are strong that they're overpaying at least one of these bills right now, for no reason other than the fact that nobody told them they could stop. That one share from you could be worth more to them than almost anything else you've ever given them. The rules already exist in your favor. Go claim them.